This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Come fly with me, let's fly away.
All right, a little blue eyes for everybody. Gotta say, just love that.
He wasn't being packed into seats in economy class.
No, I'm sure
No
he
peanuts,
wasn't.
no blankets.
He was hanging with the Rat Pack going to Vegas.
They had their own plane.
Yeah, exactly.
I think they had their own plane.
Talking about flying, we are seeing shares of airlines flying today. I'm looking at the S&P Super Composite Airline Sub-Industry Index. It's up almost 4%. If I look at it, I think there are 9 members. All 9 are higher today, Tim.
Yeah, here's why. United Airlines profit poised to beat Wall Street expectations this year as the carrier works to overcome the cost from a grounding of certain Boeing 737 MAX planes. The airline's full-year forecast suggests a sharp turnaround after this quarter when United expects an adjusted loss of 35 to 85 cents a share. It would fall well short of the average 21-cent loss that was estimated by analysts.
All right, so let's get to it. Back with us is Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst, George Ferguson. He's on the phone in New Jersey. I got to say, hardest working dude in the last week or so, thanks to all of the airline news, the Boeing news. But let's go to United, George. All about the outlook here?
Yeah, I really think it was. Results were very, very similar to Delta, where we saw some softness in the domestic market. Latin markets very soft from a fare perspective. Atlantic looked really good, just like Delta. Pacific looked okay, and so the revenue story was very, very similar. But yes, the whole discussion, in the back half of the call, I think was a lot of analysts trying to figure out why United thinks things are going to get so much better after what, a rough 1Q. And it's all about, fares and what they think the market environment. Some of it's United too, right? There's changes going on at United. They're increasing the size of some of the airplanes they're flying in the domestic market. They can offer more premium that way. So they're talking about how that brings in a higher price point. So some of it's United specific, but it's a lot of they see the market as being firmer than I think we all thought when we heard from Delta.
We'll talk a little bit more about the contrast between United and Delta here. What is United doing differently? What's different that they see? Why is it working for United but not working for Delta? Well,
I think part of this is that United is trying to become more like Delta. So as they sort of narrow that gap, that would make United a better revenue generator, because really I think one of the ways Delta stands out in the marketplace is their ability to attract premium passengers and sell those premium seats. And I think their loyalty program is quite good, and I think that really helps them from a revenue generating standpoint. And again, United changing some of the airplanes that they're flying in the domestic market lets them offer more of that premium seating, and they're telling us a story, a narrative that is they're getting more and more like Delta, even though I don't think they ever mentioned Delta. They said like another airline in the marketplace. They're getting more premium, they're telling us.
So help me out here, because Tim and I just talked about a story that's on the Bloomberg about no-frills flying emerging as travel's painful, greener future kind of moves forward. So this whole idea of the low-cost carriers, people giving, smaller seats, not putting a lot of stuff on the planes to reduce weight, to reduce their costs, but it also means they fly more efficiently and reduce their carbon footprint. Isn't that something that all of these carriers, they still need to be thinking about? Like when I hear you say they're offering more premium seats, that to me says more room, bigger, cushier seats, more weight. So help me.
But also more expensive.
And more expensive. But help me make sense of it. Like, don't they have goals that they've got to hit?
Yeah, that's one of the challenges of this business, right? And you're right. There's no more fuel-efficient airplane than one where we're all jammed in there like sardines. Might not even have a bathroom in it or something like that, right? We minimize the amount of weight excess weight we're carrying. But it seems to me that when people go places, if they have a little extra money in their wallet, they often like a little extra space to stretch out in.
Yeah.
And so, even the greenest people seem to like, to be comfortable when they're in a tube for 5 or 6 hours. The airlines, though, one of the big challenges in the industry right now is where do we go to that greener future? And a lot of time when I hear them talk about fuel efficiency, they'll talk about the airplane's kind of per trip fuel efficiency improvements. And that way we all don't have to feel as bad about whatever seat we're buying. And there's a lot of discussion about SAF, right? I think the next wave that we're going to get of the greener airline future will be sustainable aviation fuel, and the airlines have committed to buying it. There's another big challenge there because there's almost no SAF production in the world right now, but the airlines have told us they're going to buy it, so we should feel better about it because it's going to be greener.
How can you buy it if there's no production of it?
Yeah, I'm being a little facetious, but there's little to none. I mean, it can't even cover.
Also,
it can't cover 5%.
What is sustainable? What does sustainable aviation fuel mean? Like, how is fuel sustainable?
Now you ask me the hard questions, right?
It just seems like it's like an oxymoron, right?
So as I understand it, some of them can be generated from like grains and grasses. Others can be generated from like fats, food. United has that Oscar. Is it Oscar? Who's the guy on Sesame Street that is the garbage guy?
Oscar the Grouch.
Oscar. Yeah, Oscar. He's their spokesman for, I guess, for their SAF. But again, not much of it in the world, so they can't even meet multiple percentages of their operations with it.
And here's a stat. I'm just looking. The International Air Transport Association says that they estimate that sustainable aviation fuel could contribute around 65% of the reduction in emissions needed by aviation to reach net zero in 2050. I mean, they've got, no pun intended, a long runway, though, on this, right?
Aviation does. It's a real challenge.
Yeah.
Sorry.
Well, George, I was just going to say, I'm just looking forward to flying on a plane and it smelling like French fries all the time. If they're,
You're just looking forward to flying and eating those French
fries. Using
cooking
oil.
It might not be French fries. It might be the fat from around a steak. I don't know.
Yeah, it's not so bad either.
Hey, listen, going back to all right, we're going to get back on track here. Well, I'm curious, is there a Jamie Dimon or JP Morgan in the airline industry? You know what I mean? A voice, a company that is above the rest, sets the tone.
I hate to call any of those guys out that way, but look, I think that Ed Bastian has done a nice job at Delta of trying to, be sort of the voice of the industry, and maybe that's because Delta looks like the leader in the industry, one of the more profitable ones. I think he's been one of them, and certainly Scott Kirby, United, is trying to do a similar thing. But I would say, Ed Bastian probably has a little more of the pulpit right now, maybe the way to say it.
Okay, well, speaking of United, I want to talk a little bit about what else we learned on the company's call. We're learning that United is no longer counting on Boeing's largest 737 MAX model as the plane maker's manufacturing miscues threaten to further delay an aircraft already years behind schedule. We learned this thanks to an interview with Scott Kirby earlier on CNBC that said that that the carrier hasn't canceled its order. United has removed it from its internal plans. How does a airline do this when pilots are trained on certain equipment and when the infrastructure is set up for that equipment?
Yeah, I mean, the MAX models, basically the pilots have the same type rating and can fly the different MAX models. They could fly the MAX 8, the MAX 9, the MAX 10, the MAX 7. The 7 and 10 still aren't certified. And as I heard that discussion, I think a lot of it was really around they're removing it from their plan for right now, but they still want the airplane. It's going to get pushed out. There was a lot of discussion about CapEx expenditures, too, for United, because United has one of the more aggressive fleet plans, adding a lot of airplanes, that knocks down either cash or requires debt to financing it. I think the analyst community questioning that a little bit, right? They also want a fair amount of free cash flow to feel good about the shares. And so I think that was part of hey, CapEx isn't going to be as high as you all think it's going to be. Relax.
So
but they still want it.
But it also sounds like he's, when they're reconsidering, we're thinking like at all this thing. I mean, it sounds like Kirby's kind of like, hey, folks, you got to get your act together. Like, right?
I mean, don't they know that?
I think they do know that, yeah. And he as much as maybe he's doing a little bit of that, he also said, Boeing's a great company that has done some, wonderful engineering achievements. I'm not quoting him directly, but things along those lines. So he had a little bit of salve for that. for that discussion too. I just think it's probably hard to put that on a schedule for when those airplanes are going to show up, given where the industry is right now, and especially Boeing. And so I think he was crying uncle a little bit on that, and they will figure it out when it's ready to come.
And Boeing, Stan Deal, Boeing's commercial airplanes chief, apologized following Kirby's interview. We have let down our airline customers. We are deeply sorry for the significant disruption to them, their employees, and their passengers. He put that out in his statement. Having said that, and Tim and I have talked with you about this, George, I mean, no offense, but these big major carriers don't have a lot of other options in terms of where they're going to buy their planes, at least not right now.
Nope, there's only two, Boeing and Airbus. And one of the other items to think about is there are training costs, right, for the maintenance people that maintain the airplanes, for the pilots that fly them. And so you don't want to have, sort of a scattershot fleet, right? You like to have some commonality there. It saves you costs. United's already sort of down the road with Boeing. And so it would be really hard to turn that into an Airbus shop. It's not that they don't have any Airbus, but they've done a lot of orders from Boeing. I think they got some great prices from Boeing because they kind of came in, right after the pandemic, as the Chinese weren't taking deliveries, still not taking deliveries out of China. Boeing needed a customer. They sold a bunch to United taking a lot of deliveries every month as we watch them. So that's a really, really important customer to Boeing. But at the same time, it'd be really hard, I think, for United to walk away.
Where does it leave a company like Southwest that exclusively has a fleet of 737s? They literally have no choice, right?
Yeah. I mean, and that's one of the things we watch kind of constantly is, we're concerned about the quality of Boeing. If we saw like a Ryanair or a Southwest that has a pure fleet of Boeing, or an Alaska or a Copa, if we saw one of them leave, that would be a really, really, really bad sign. So we watch that very closely for those core customers.
That would be a bad sign because it would be the switching costs are so high, George. You mentioned retraining pilots. Yep. You need to retrain every pilot to fly Airbus equipment. The maintenance, parts, the list goes on. That's how these discount carriers do keep costs low. They have the exact same equipment. So these planes are interchangeable no matter where they are.
Exactly.
Hey, American, JetBlue, Southwest report later this month. I don't know if I'm leaving. I'm sure I'm leaving some folks out. What are you what's on your radar here?
Yeah, so we're watching domestic fares very closely. They matter a lot more to the low-cost carriers because they just don't do overseas, right? I told you Atlantic, transatlantic was so strong. They won't have that in their profit statement. So we'll watch very closely to see what the state of basic economy is. Because, to us, it feels like the story we got from United today and part of the results we think we saw at Delta 2 is that maybe there's not a lot of premium seating in the marketplace. There has to be a lot of discounting. But there is a lot of basic economy seats in the domestic market. So we'll watch those. Again, we'll watch those yields very closely. And we're going to see a similar story at these other airlines, too, that's going to be the high cost of labor is really taking a bite out of the income statement. And the challenge, again, for the carriers that only have domestic business and fares are falling harder there, it'll be really hard to maintain profitability, having given so much to the pilot.
And in the last minute that
Southwest just did.
George, we have about 60 seconds left. Where does it leave Boeing? What are you watching for next with Boeing and getting the MAX 9 back in the skies?
Well, I think that is it, right? There are discussions with the FAA, how much the FAA wants to get together with Boeing and really get in place an inspection program so they can get the MAX 9 up. And then we want to hear from Boeing what they're going to do in the factory to stabilize production, because clearly there's just not either enough oversight or training inside their factories and the suppliers. We want to hear about that.
All right, we're going to leave it there. Hey, thank you so much. Really appreciate it. As always, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst George Ferguson on the phone in New Jersey. Looking at the S&P Supercomposite Airlines Sub-Industry Index.
Say that 5 times fast. How dare you?
That would be tough. At its highs today, up 5.6%. Wow. Right now, still up just shy of 4%. And as I said, 9 names in the index. Every one of them is up. UAL up 6.4%. Looking at Delta's up almost 3%. American up 3.4%. Southwest up 3.6%. What is this one?
Which one?
Sun Country.
Yeah, Sun Country, a regional out of the Midwest.
Up 4.6%. Told you, across the board. All right, stick around, everybody. Bloomberg Businessweek continuing on this Tuesday. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, it's time for another edition of Bloomberg Plugged In. It's your weekly look at EVs. And speaking of EVs, some huge news coming from our own Mark Gurman this afternoon. Apple pivoting to a less ambitious design with the intent of finally bringing an EV to market. So after previously envisioning a truly driverless car, the company now working on an EV with more limited features. That's according to people with knowledge of the project. For more, let's bring in Ed Ludlow, the co-host of Bloomberg Technology on Bloomberg Television. He joins us now from our San Francisco bureau. Ed, some big news from Mark earlier in the day today. It's not just the fact that Apple is pivoting here. The date that this thing could actually come out is actually slipping also. What do we know?
Yeah, I look at it as Apple scaling back its near-term ambition, both on the product and what the product will or won't be, but also when they can deliver it. So, a big piece of news is that the Apple car, which we don't really know much about, is now likely to launch in 2028, as opposed to the previous target of 2026. And when it comes to the product, they've been working on this for a decade, and the original hope was an all-singing, all-dancing premium electric vehicle that had a very high degree of autonomous driving. Now it seems, according to Mark's reporting and sources, that we're talking about level 2+, which is something akin to what Tesla's autopilot can already do today. So a real scaling back of the experiential and technological ambition for that product.
All right. If you're just waking up from a 50-year sleep and you're like, or no, let's be more realistic. How old is Apple as a company? 30 years? How old is Apple? Yeah, 30. So maybe you're waking up from a 25-year-ish sleep or something, and you're like, Apple making cars? I still kind of try to get my head around this, Ed. Why it's so important? Is this part of being in, the Apple system, the Apple infrastructure? Does this just make it even more, prominent? Help me out here. Every time
it's a completely reasonable question. I mean, an important piece of reporting is why this all came about. And if you read Mark Gurman's story, it's that the board sat down with Kevin Lynch, who's the executive that leads the Apple Car program, along with his responsibilities with the watch, and Tim Cook, and said, hey, show me some progress here, because they've been working on this since 2014. The kind of philosophical or big picture idea is that the car is where you spend so much of your time. You interact with the car for so much of your day in the same way you have that relationship with your smartphone. And it would be a new product category for Apple. And they feel like on the battery technology side, the UX side, interacting with the car in the cockpit, and the technology that goes into a modern day car, they want a piece of that market. And as Mark writes in the story, in Apple's case, we're talking probably about a $100,000 vehicle. And they may not make any profit on that for years and years and years, but this is Apple we're talking about. They're good at selling stuff, expensive stuff, at scale, around the world. And so they're interested to get in on the automotive space too.
Guys, I have some bad news. We're getting old. Apple's almost 50 years old.
It's 50 years old.
47 years old,
All right.
1976.
So you fell asleep 30 years ago, 25 years ago, and you woke up today and you're like, what, Apple car?
Yeah.
It still works.
Okay, it's a good point.
The iPhone's been out for 10 years, 12 years? What is it now?
Yeah. Well, Ed, you report on technology. You're the co-host of Bloomberg Technology each day on Bloomberg Television at 11. So you also report a lot on cars. So these are both, this is like your world meeting. Given what's happening with EVs right now and what's going on with the appetite for EVs, how do you think Apple sort of plays in this space? Is it look, we're totally doing conjecture here because, as you said, this is 2028. It's years off. But are we thinking about this like a premium product category like all of other Apple's products? Like, what does that look like for a car?
Well, I don't know that it's conjecture in the sense that, Apple's vision of the world was a place very similar to what Waymo is working on right now with autonomous driving fleets, right? That in the future, whatever that may be, 2028 or otherwise, we may not need to drive our vehicles. We don't need to have a steering wheel with our hands on it constantly. And that puts more emphasis on what it's like to be a passenger in the car. Maybe you're on your way to work. Maybe you are doing the school run, whatever it is. and you're making best use of your time while you're in that vehicle because you don't need to be paying attention to the road. That was what Apple's goal was, this premium EV where there was a high degree of autonomous driving, the car would drive itself, and you're surrounded by high spec and you can get on with things. But bringing that to market, as we know, not just from Apple, but the Teslas of this world with full self-driving beta, the German automakers, Cruise, which is kind of really suffering right now in the purpose-built autonomous shuttle space. It's so hard. It's so hard to do it. And so Apple is caught in that story and is paring back because ultimately they put a lot of money and time into this project. They've had a lot of chiefs, a lot of talent coming in and out the door. And now they're basically saying, according to Mark's reporting, but also what I heard too, it's just like, we need something tangible, guys, at some point. So let's make it a bit more simple.
And, it can't be ignored, these big tech giants, right, who have, impacted our world so much, whether it's Alphabet, whether it's Apple, whether it's Amazon. They all are, in that transportation space. They're trying to figure out kind of what's the next level way we get around. So there's, it's hard not to kind of say there's got to be something to it. There's a lot of smart people who are working on this.
Well, look, I'm a big user myself of Apple CarPlay. Mm-hmm. For my sins, I drive a combustion engine car and I connect my phone via short-distance Wi-Fi and Bluetooth to use Apple CarPlay. It's a great piece of software. So Apple's already in the car market in that sense, but then think about their footprint as a global manufacturer of consumer electronics and their command of a vertically integrated supply chain. That is kind of the thinking here as well, that if Apple can make many millions of iPhones, would they be able to put that same process into the context of a car?
Yeah.
So, Ed, you mentioned that for your sins, you're driving an internal combustion engine.
You and me too.
I got to tell you,
not by choice.
The Toyota chairman doesn't think you're so wrong because he believes that electric battery EVs are going to reach at most 30% market share. The rest is going to be taken up by hybrids, hydrogen fuel cells, and fuel-burning cars. So is that idea of an all-EV future looking more and more less likely?
Toyota is so important, and we're paying attention to this story because Toyota sells 10 million cars a year. Tesla sold 1.8 million battery electric cars last year. Toyota sold 10 million with all kinds of powertrains. And what the Toyota chairman is saying is it's not 30% next year or the year after. He's saying full stop. They see a world where long into the future, you have battery electric, you have plug-in hybrid, you have hydrogen, and you have combustion engine cars. And a really big thing they're leaning on, which I think we probably lose sight of in this country, given how blessed we are to live in a country like America, there are 1 billion people around the world who don't have any access to electricity. So how can one have an electric vehicle without anywhere to plug it in? And so that's the kind of future that he envisages here.
Yeah, no, it's interesting, right? And I think about the conversations that we've had over the last year, especially with, the pickup in hybrid sales. Who'd have thunk, right? We kind of thought that was in the past, but yet we see it playing out. A fascinating story, both of them, to be quite honest, in this ever-evolving world when it comes to the automotive space. Yeah, interesting. Ed, you're amazing. Thank you.
Thanks, Ed.
Thank you.
Apple car.
Also, Ed, you got a
yet.
fancy car, like a kind of a new car, if you can do the wireless CarPlay.
I think I've disclosed it on X, formerly known as Twitter, but I drive a 2022 Tiguan. And at that time, I tried to buy an electric vehicle, but this was when you had to wait 6 months for a Model Y or 6 months for a ID4. And so that's what we got because we need a car to get around the Bay.
Wow. How times have changed in less than 2 years.
Exactly.
It's crazy. You need a car when you need a car.
You need a car, yeah, especially.
Wireless CarPlay is great, though. I'm still full on wired, Carol. We got to plug our iPhone in to get CarPlay working.
Yeah, I know. We got a mixture in our cars. All right, Ed Ludlow, thank you. We're going to let you go. Ed Ludlow, co-host of Bloomberg Technology on Bloomberg Television.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Netflix. Earnings are out. Stock is still up in the after hours, but off its highs, still with a gain of about 3%. So let's get to a little bit more analysis.
Yeah, we got Bloomberg Intelligence Technology and Media Analyst Geetha Ranganathan on Zoom from BI headquarters. Geetha, good to have you with us. You've only had 9 minutes exactly to look at these numbers. It was a blowout number in terms of subscribers.
Easy peasy for Geetha.
What sticks out to you?
Well, what sticks out to me, apart from, of course, the subscriber blowout, is all of the financial metrics. And I think one of the things that really, really stuck out to me was the operating margin commentary. They were expecting 20% for 2023, about 23% on the higher end for 2024. Now they're expecting closer to 24% for 2024. And this goes back to your point that you were talking about a little while ago on profitability, right? And what we've really been concerned about across the media landscape for all of these streamers is the lack of profitability. Netflix, of course, is the only one that's profitable. Their operating margin getting even higher and higher, just telling us that not only are they able to pull a lot of levers when it comes to monetization of their existing base, getting newer subscribers on board, but then also showing extreme discipline when it comes to content costs.
Is that why we don't really care that much about the fourth quarter EPS miss? 211 versus 219 is what the street was looking for. Because I think Romain was making the point of, okay, great on the subscriber, gain, if you will. But look, they missed their numbers in the fourth quarter EPS. Is that just backwards looking? We don't care because it looks so much rosier going forward?
I think so. I mean, and they had kind of alluded to this. They said that, you are going to expect, you are going to see a little bit of bumpiness when it kind of comes to that acceleration in what they call their key metric, which is, the average revenue per member. And they're doing different things, right? They're tweaking prices a little bit here and there in order to kind of reinvigorate subscriber growth. And it's playing out differently in different markets. But I think that the bottom line here is that, free cash flow in a very good spot, almost $7 billion in 2023, and they're guiding to at least $6 billion. I think it'll come in way better than that in 2024. And then, of course, that whole revenue reacceleration story is really back in place. We saw over 12% for 4Q. We were expecting around they guided to around 10.7%. And then again, we're seeing further acceleration going into 1Q as well. So, definitely a lot more mojo left for this company.
We're speaking of mojo. I'm always kind of blown away by some of these companies and their free cash flow. So Netflix says sees 2024 free cash flow of about $6 billion, which is pretty much in line with the estimates. I mean, that's a pretty big number. Help me, yeah?
It is an absolutely huge number. I mean, remember, just 4 years ago, Netflix was burning $3.3 billion of cash. So all of those, investments that they kind of made in terms of original content, all of that is kind of really paying off right now. And they seem to be even taking a little bit of a step back, I would say, with, their original content investments. If you just kind of look at the profile of their content, they are saying that 45% of their most watched titles are actually licensed content. So just kind of goes to show us they don't really need to write these huge billion-dollar checks for original content anymore. They have a pretty decent pipeline.
Wow.
They can play it safe. They can experiment with new content, which is exactly what they're doing with that TKO deal, with the WWE content for Raw. And they can probably go and dabble more with, different kinds of content and see how it plays out, especially for their advertising ambitions.
That's what I wanted to talk to you about, because there's this part of the letter to investors that really sticks out to me, saying that if we continue to execute well and drive continuous improvement with a better slate, easier discovery, and more fandom, while establishing ourselves in new areas like advertising and games, we believe we have a lot more room to grow. They say it's a $600 billion opportunity across pay TV, film, games, and branded advertising. And Netflix today only accounts for about 5% of that addressable market. How big do you think Netflix can get when it comes to games and when it comes to linear TV? Like, the stuff that they're doing with live.
Absolutely. So I think the one thing that we've kind of seen them do really well is have this tremendous scale. Netflix has kind of become a habit for so many of us. If you kind of think about what do we want to watch, we naturally kind of almost gravitate towards Netflix. So they have this built-in base right now of 260 million subscribers across the board. And so now it's up to them to kind of add more and more content. I'm not so sure about the gaming piece, but definitely advertising. Advertising is going to be absolutely huge for them. They just now have to make sure that they're able to offer the right content that kind of really lends itself well to advertising, content that kind of really gets advertisers, more enticed to kind of come to the platform, because they obviously have the captive user base. So we're really going to have to see how they do with that. In terms of gaming, I mean, it's kind of been a pretty slow ramp. Yes, it definitely is a great opportunity, but again, I don't necessarily think people think of Netflix as the first kind of spot they want to go when they want to play a video game. So that might be a little bit of more of a slower ramp.
Hey, in their letter to shareholders about the fourth quarter, Geetha, they say, according to Nielsen, in the U.S. in 2023, Netflix had the #1 original TV series 48 out of 52 weeks, original film 41 out of 52 weeks, which was a significant increase, they said, on 2022. And they acquired series 44 out of 52 weeks. I mean, I know when I watch, quite honestly, I check out Netflix, I check out Apple TV, and I think I might check out Max. Like, that's kind of where I go. Having said that, you said before, 45% of the most watched on Netflix is licensed content. So does that support why they are doing this deal with WWE?
I absolutely think so. I think they have realized that, all types of content. Netflix is now just basically this destination, right? We're seeing these old shows kind of come back and find new life, or find their second life on Netflix, if you will. So many of these shows that we'd kind of almost forgotten about on rival platforms, on rival networks, on rival networks, are doing so well on Netflix. And they're really kind of going to try and capitalize on that. And I think that's absolutely what the Raw deal is about as well.
So how many more deals do you think we'll see like that? I mean, again, I can't emphasize this enough for people who, haven't covered Netflix for years. It's like seeing Netflix do deals like this is sort of the antithesis of what Netflix said it wanted to be, right? This idea of a place we want to turn into HBO. We are. And look, I mean, to be fair, Netflix has pivoted many times in their history. Did you ever think
you'd do radio on TV and on
TV on the radio,
streaming? I'm just right. Yeah. It's all changing.
No, you're right. And that's in Netflix's DNA. After all, this is the company that pioneered sending us red envelopes with DVDs inside them, and basically invented the category of on-demand streaming, Geetha. Like, this is a really big deal. This is a big transition for the company.
This is absolutely a big deal, Tim. But the good thing is they're not afraid to go back to kind of the drawing board and kind of restart everything, if you will. So, obviously we're going to see a lot more moves from them. The one thing, of course, that they did say is no linear networks for us. So I guess, nothing on the Disney front there for them. Also, probably no big studio deals. But I think the deal here with Raw definitely signals to us that they are interested in the live sports space. So we do know a lot of deals that are kind of coming up for renewal, whether it's, the NBA rights deals, or whether it's UFC, a lot of other smaller kind of packages as well. And maybe Netflix is going to be a big player there.
They certainly have deep pockets. Hey, I just got about 40 seconds left here. #1 question you would put on the analyst call with Netflix?
I think absolutely want to know if they are going to release their number of ad subscribers. And again, just kind of want to get their take on what the TKO deal means, and whether it's going to spawn future such deals.
All right.
Hey, wait, I have one more question. Does Netflix want a premium subscriber more than an ad tier subscriber? Like, who's the best subscriber Netflix wants?
Good question.
You'll be surprised, but the ad tier subscriber, even though they're only charging $7 per month to the subscriber, they're actually making a whole lot more from the advertising part of it. So they're actually agnostic between a premium subscriber and an ad tier subscriber, because they're able to kind of charge all that extra money to the advertisers, and hopefully they'll be able to keep cranking that price up. So the ARPU is actually the same.
Advertising.
As hard as that is to believe. Yeah.
Right? Can make a lot of money.
It's old as new again.
Geetha, you rock always. Bloomberg Intelligence Technology and Media Analyst Geetha Ranganathan on Zoom from BI headquarters in Princeton, New Jersey. That stock, by the way, Netflix, up 6.6% in the aftermarket. This is Bloomberg.
I'm driving in my car. I turn on the radio.
Yeah, how about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, just about 18 minutes left in today's trading session. Let's get to it. Our Drive to the Close guest. Back with us is founder and CEO of Verdence Capital Advisors, Leo Kelly. He's here in our Bloomberg Interactive Broker studio. Great to have you here with us. I don't think we've said Happy New Year yet, have we?
Happy New Year.
Happy New
It's
Year.
not too late.
Box checked.
Check.
You got Carol. You got 7 more days.
7 more
8
days.
more
I can
days.
still do it. How are you looking at the new year?
Well, I think you have to look at the new year this year, and you have to put the last 6 weeks of last year in perspective. I think that's probably the best way to approach the new year.
Meaning what?
Well, that run at the end of the year was pretty extraordinary.
Yep.
And I think the optimists won. I think seasonality won. And what tends to happen in a moment like that, first quarter tends to be one that sets it back and puts it back in place. And so I think we're trying to be level-headed in the first quarter. Look at allocations, rebalance, get portfolios back to neutral, and not get overzealous with the enthusiasm that I think might be a little bit overzealous.
Well, we're already up 1.9% year to date on the S&P 500. This will be the third day in a row of a record close if we close in the green today. Are you talked about holding cash last time you were on with
Early
us?
November, yeah.
Yeah, it wasn't that long ago.
Are you still?
Yeah, are you still
Did
holding
you
cash?
hold on to that cash?
The 7 stocks are up 1.9%. Again,
But we have seen a broadening out. To be fair, we've done a lot of research, in terms of if you look at a lot of the names that we've seen a broadening out in terms of the rally or stocks taking out like 52-week highs. So we've seen that happen.
Yeah, I think so. This year it's not as broad. And the start to this year. But take a step back and say, last year the S&P 500 up over 20%, great year. Same 500 stocks equal weighted were only up 12. So while it did broaden out, it didn't catch up. And so there is still room there. Now, to answer your question, we were equal weight equity, meaning we weren't overweight equity. We did have cash, but that was in lieu of fixed income elements. Okay. Let's face it. There's no spreads in the high yield market, so it doesn't pay to take risk there. We extended duration earlier in the year when everything went up to 5%. As things pulled back, it doesn't make any sense in our view to hold long bonds right now. We're equal weight on equities. We're pulling back on the growth because this is starting to run. And dare I say, there's an AI bubble brewing. Right? We're not there. That takes.
Are you saying there's an AI bubble brewing?
I think bubbles are 3 phases, and I think we're getting into phase 2 right now, where the enthusiasm is starting to pick up steam. You're starting to see folks invest in the return of the asset more than the asset itself, and that's when things start to get really heated. The challenge there is you never really know how high it can go, and so having exposure is good. We're in the markets. We're neutral weighted on equity. We're just not chasing right now. And I think that's where investors have to be smart. Don't chase this thing. Be disciplined.
So can I ask you, did you guys miss out though in terms of your call in November on the rally, the run up?
No. We did great. Our equities had a great year. Our portfolios did fine. As I said, we never went underweight equity.
Okay.
Right. We were equal weight in all of our portfolios. We also have a large private equity allocation, and we've owned private credit before it became this fashion in vogue asset class.
It's been around for a long time.
Yeah. So we've done really well with that. Our portfolios did fine. We did not miss out. I guess you could say if we missed out on anything, it wasn't massively overweighting 7 stocks that made the market look a little bit better than it was. I think if you're honest about the market last year, other than a few stocks, it was a pretty lousy year through October. The last 6 weeks saved this market. And everybody feels great about last year. It's a 6-week year, and that's seasonal, right? That's the Santa Claus rally that we see. The market followed a very consistent pattern.
And just regaining ground that was lost. No, again.
Well, what it did was
momentum can mean something because we are expecting a very different Fed, and we've only got about 30 or 40 seconds left. But if the Fed starts to cut rates, does that change your thinking about kind of an equity move?
We're still like equity, and we'll continue to be equal weight. What we're not doing is chasing. We're not running after growth. I do think the market is ahead of itself on Fed cuts. Asset prices are reaching all-time highs. The economy is gaining some strength. We got high consumer confidence. the Fed's going to get dovish? That's not logical to us. So maybe it cuts. Remember, we're just above neutrality. So yeah, maybe a cut, maybe two, but this 6 cuts and we're going down back to where we were, not happening.
Either way, it sounds like it's going to be an interesting year. We look forward to checking back with you as the year plays out.
Come back and hang out with us.
All right, I'll see you tomorrow.
All right, Leo Kelly.
Sounds good.
Maybe not that soon. No, I'm just kidding. Leo Kelly is founder and chief executive officer of Verdence Capital Advisors.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.